Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is May 26, 2026. We're Elena and Marcus.
And if you look at today's data deck, we are essentially looking at a market fighting itself.
Yeah, it's like slamming your foot on the gas pedal and, pulling the emergency brake at the exact same time.
Exactly. To set the stage for you today, there are really three critical themes we're tracking from our latest run.
Right. First up is the rate regime shift. Global central banks are aggressively repricing for higher rates.
Yeah, the institutional consensus is actually bracing for a December Fed hike now under Chair Kevin Warsh, which is largely a response to ongoing supply shocks.
Right. And then our second theme is what we're calling the mega cap tech squeeze.
Right, because U.S. equity indices keep hitting record highs, but the breadth is dangerously narrow. I mean, it's being carried single-handedly by a historic rally in semiconductors and memory chips.
And finally, the third theme from our daily desk data is the geopolitical premium. Energy markets are tightening really rapidly.
Yeah, we're seeing Brent crude pushing toward $100 a barrel amid those escalating clashes in the Strait of Hormuz.
Moving to today's data, let's start by unpacking that macro and global rates picture.
Sure. So right now, the U.S. 10-year yield is sitting at 4.487%.
Which is high.
It is. And the most notable takeaway from today's proprietary updates is the curve itself. We're seeing a distinct 10-year, 2-year curve bull flattening.
Right. But what stood out to me in the data deck is that demand at the front end was actually somewhat soft today.
Yeah, exactly. Look at today's 6-week bill auction.
The bid to cover ratio dropped to 2.71 times, right?
Yeah, which is a measurable step down in appetite. And, that softness at the short end connects directly to this massive regime change we're seeing in institutional consensus regarding the Fed.
Because bond markets are now actively pricing in a Federal Reserve rate hike by December 2026.
Right, under the new chair, Kevin Warsh. And to put that into perspective for you, this is a complete 180-degree reversal.
I mean, dealer desks were pricing in an easing cycle just 3 months ago.
Exactly. And this hawkishness isn't just domestic, it's a global contagion. Over in Europe, the ECB's Isabel Schnabel explicitly signaled that a June rate hike is needed.
Right, to combat the inflation shock from the Iran war.
Yeah. And her comments immediately sent German 10-year yields up 3.7 basis points.
Okay, wait, I need to push back on this using the first principles rule.
Sure, go ahead.
Because hiking rates directly into an oil-driven supply shock. I mean, it feels like stepping on the brakes of a car while going uphill.
That's a good way to put it.
Central banks can't pump more oil.
Right.
So, in simple terms, how does this dynamic actually impact a regular investor's portfolio?
Well, it's true they can't clear a shipping lane. But when a supply shock hits, inflation embeds itself into the broader economy. So the central bank's only tool is to destroy enough consumer demand to stabilize prices.
So they basically make borrowing prohibitively expensive to force a slowdown.
Right. And for a regular equity portfolio, higher interest rates mean a higher discount rate.
Meaning future cash flows are worth less today.
Exactly. So if you hold non-tech equities companies without explosive near-term growth, their valuation multiples just mechanically compress. It severely restricts broad market performance.
Understood. And that actually highlights the extreme divergence in today's proprietary updates.
Yeah, the equity index bifurcation today is wild.
Because the S&P 500 closed up 0.61% at a record 7,519.
Right, and the NASDAQ 100 surged 1.76% to break 30,000.
But and here's the catch. The equal weight S&P 500 was essentially flat.
Yeah, the breadth is historically narrow. We are basically looking at a semiconductor squeeze.
I mean, just look at Micron. Ticker MU surged 19.3% today.
Yeah, it officially crossed the $1 trillion market cap threshold.
Which is just massive. And it pulled Advanced Micro Devices ticker AMD up 7.8% and Qualcomm ticker QCOM up 4.5%.
Right. Based on today's data deck, semiconductors now make up an incredible 18% of the S&P 500.
But this euphoria is highly isolated, isn't it?
It really is. It didn't even translate entirely across the global tech space. For instance, ASML dropped 2.9% today.
Which dragged down the European indices, right?
Yeah, the Eurostoxx 50 fell 1.18%. But over in Asia, South Korea's Kospi surged 2.6%, entirely on that memory chip thematic.
Right. But if we pivot to the consumer realities,
Mm.
it completely contrasts with this tech rally.
Oh, for sure.
I mean, in this restrictive rate environment, broad market consumer names are struggling. We're seeing it with Target, ticker TGT, and Walmart, ticker WMT.
Yeah, and Home Depot, ticker HD, and Lowe's, ticker LOW.
Meanwhile, the off-price retailers like TJX companies, ticker TJX, and Ross stores, ticker ROS, they're clearing really high bars right now.
Because consumers are trading down. And our daily desk data on Chase spending backs this up perfectly.
Right. Discretionary spending growth for lower-income consumers actually peaked back in February.
And it's decelerating fast. Gas prices are surging, absorbing a much larger percentage of consumer wallets.
Right, which completely starves those traditional retailers of capital.
Exactly. And if you look at institutional consensus regarding positioning, it gets even more precarious.
Oh, the flows data. Hedge fund gross leverage is sitting at the 94th percentile right now.
Yeah, a 5-year high. And mutual fund cash balances are scraping record lows at 1.4%.
The corporate buybacks are stepping in as a support, right?
Yeah, they're acting as a major pillar, accelerating 40% week over week.
But I have to point out the fragility here. I mean, if leverage is at a 5-year high, mutual funds are out of cash, and dealer desks are long gamma.
Yeah.
Aren't we playing a dangerous game of musical chairs? It feels like a high-velocity cartridge.
That's an apt analogy.
I mean, the AI trade is powerful, but with short interest this high, the market seems primed for violent squeezes rather than, genuine fundamental expansion.
On that point, the most likely catalyst for that kind of violent volatility resides right now in the commodity markets.
All right, the hard assets.
Yeah, we are tracking a severe oil shock. Brent crude jumped over 3% today, pushing toward $99.35.
And WTI is sitting near $93.60.
Exactly. And the catalyst is entirely geopolitical.
We're seeing U.S. and Iranian forces clashing near the Strait of Hormuz.
Right, which threatens a prolonged supply blockade precisely as commercial stocks are draining.
But wait, here is a glaring paradox in today's data deck.
What's that?
Despite crude oil rallying this hard, the energy sector equities tracked by the XLE were actually the worst performers today.
Yeah, it's a massive equity commodity divergence.
But why are they completely decoupling from the underlying commodity? Is institutional consensus viewing this Hormuz premium as transient? Or are equities actually pricing in a severe demand destruction recession?
It's the latter. Equities are forward-looking. The spot oil market is panicking over immediate physical supply blockades today.
Right.
But the equity market is looking 6 months down the road. They see the Warsh Fed hiking rates to fight this oil-driven inflation.
Which eventually crushes economic growth.
Exactly. A recession destroys the industrial demand for energy, so energy equities are pricing in that future demand destruction, completely ignoring the physical oil constraints of today.
I see. And briefly touching on metals in our latest run, gold remained relatively flat, hovering around $4,507.
Yeah, mostly offset by the dollar strength. But copper rose 0.7%.
Which is heavily supported by the massive infrastructure demands for AI data centers, right?
Exactly. It's tying the physical commodity space directly back to that semiconductor squeeze.
Correct. So if we synthesize all of this, we have a market environment exhibiting severe cognitive dissonance right now.
Yeah, across almost every asset class.
I mean, we have record valuation multiples being paid for mega cap tech like Micron and AMD.
Right, all based on this assumed AI CapEx supercycle.
Yeah, but it's operating right alongside the bond market that is screaming that persistent war-driven inflation is going to force central banks to hike rates.
And all of this is happening while the average consumer budget is just completely suffocating under $100 oil.
It just doesn't add up.
It doesn't. And that tension is showing up in our volatility tracking. Because despite the S&P 500 hitting an all-time high today, the VIX paradoxically ticked up to 17.01.
Which means the options market is aggressively buying tail protection.
Exactly. They're buying insurance against a sudden drop.
Which leads me to a final sort of provocative thought for you to mull over today.
Go for it.
Our latest run models that U.S. pensions are preparing to mechanically sell $14 billion worth of equities for month-end rebalancing.
That's a huge mechanical flow.
Right. So in a market where liquidity is thinning, breadth is basically non-existent, and everyone is huddled on one side of the AI boat.
Yeah.
What happens to this historic tech rally if the Strait of Hormuz conflict triggers an inflation shock that the algorithms simply can't ignore?
It's a precarious setup for sure. To quickly recap today's main takeaways, rates are aggressively repricing for a hawkish Warsh Fed. Second, semiconductors are completely masking a flat, fragile underlying stock market.
Yeah.
And finally, energy markets are bracing for a prolonged Middle East blockade, signaling deep trouble ahead for the consumer.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.